Yo guys, what's up? This video will be completely only about fair value gaps, inverse fair value gaps, and BPRs, balanced price regions, so to say. And yeah, I'm just trying to go very briefly over these building blocks. First of all, what are fair value gaps? So you've probably heard a lot of day traders talking about fair value gaps. Maybe you've seen them also drawing them into the charts, but you just don't understand what this actually means. As you know, we are teaching you the smart money concept of trading. This basically means we are searching for confluences that have a meaning regarding how the market is moving, regarding how the buyers and the sellers are behaving on the market. So this basically means we're not trading with some imaginary lines, trend lines, or whatever. We just use the science behind the market psychology. So a fair value gap is basically an imbalance or a displacement between buyers and sellers. So I will show you practical examples in a second, but most of the time fair value gaps are being created when there's a huge sell-off or a huge buy. So there's a displacement between buyers and sellers in an aggressive way. And you have to imagine that when someone, for example, sells a lot, there is a huge displacement being created. And we can just go over directly on the chart to just show you an example. You see here, pretty basic, you see here a huge sell-off candle, like this black bearish candle. And it created a fair value gap right here. I will explain you in a bit how you draw in fair value gaps correctly. But you see that there is some space between these three candles. The first bearish candle, the second, which caused this huge sell-off, and the third bullish candle. Because a fair value gap is always formed of a sequence of three consecutive candles. And you have to imagine now that because of this huge sell-off, there's still resting orders laying in this space, in this fair value gap, because it didn't trade fairly, because this huge sell-off caused a displacement. This means you can imagine there's still orders resting in this fair value gap that didn't get triggered yet. But you can see here perfectly in this example that in this case it's a bearish fair value gap because it is caused or created by a huge sell-off. You can see that price wicks back in with these following candles into this fair value gap and continues to move lower. And the reason why fair value gaps always function like a magnet is because there's resting orders here that wants to get triggered, also resting liquidity, and the market wants to seek out these limit orders or these orders in general and then continue in the direction that it wanted to continue. So it's basically a magnet of price, and it is a high draw of orders, of resting orders that are sitting there that didn't get triggered because of this huge displacement. Then we want to retest this fair value gap and we continue to move lower. So this is a perfect example of a fair value gap. Fair value gaps can be seen on every single time frame. It doesn't matter. Price is fractile. This basically means price moves this in the same patterns on all time frames. You can spot fair value gaps on the 1 minute time frame, on the 5 minute, 15 minute, weekly, monthly, yearly, not only on S&P and NASDAQ, on every single stock, on every crypto coin, everything. You can spot fair value gaps everywhere. Why is that? Because fair value gaps are displacements of huge sells and huge buys, and you have this happening on every single market. All right. So now let's just talk about how you can spot fair value gaps. You've seen in this example that I drew in a fair value gap. So there are basically two types of fair value gaps: bullish fair value gaps and bearish fair value gaps. And to visualize this even better, I brought this little picture right here and make it a little bigger. How to identify fair value gaps. So first of all, you can see that a bullish fair value gap is formed if the displacement was caused by a big buy, and a bearish fair value gap is formed if the displacement was caused by a sell-off. And you can see also that fair value gaps, as I said previously, are only formed of 3 consecutive candles. And the same thing goes for the bearish fair value gap. So basically, it's pretty simple how you draw in fair value gaps. You just take the highest part in this bullish fair value gap example, the highest part of the first candle, including the wick, and the lowest part of the third candle, including the wick. So this is how you draw in the bullish fair value gap, and the same goes for the bearish fair value gap. From the first candle, you take the lowest part to the third candle of the highest part. This is how you draw in a fair value gap. Bearish and bullish fair value gap. It's pretty easy. So now we want to explain to you what is an inverse fair value gap. So an inverse fair value gap is basically when market is not respecting this fair value gap, meaning like retesting and then moving out of it. An inverse fair value gap means that we inverse this fair value gap by closing over or underneath a bullish or bearish fair value gap. So let me just try to find an example here for you really quickly, because yeah, we can almost see this happening every single time. Perfect example right here. So let's just mark out this bearish fair value gap. So we see we have a huge sell-off, huge displacement to the downside. This is our first bearish candle. This is the second bearish candle. And then we have the third, a bullish candle. So how do we draw it in a bearish case? We take the lowest part of the first candle to the highest part, including the wick of the third candle, which creates our bearish fair value gap. In this example, we can see that price, yes, wicked in, respected this fair value gap a few times, and then moved lower, but then following we have a huge candle to the upside, which closes with its body over the bearish fair value gap. And this is what we call an inverse fair value gap, because price didn't respect this fair value gap, we closed above it. And look how beautiful this example is also playing out, because this inverse fair value gap is a shift in the market structure, or can be an indicator for a shift in the market structure, can be similar seen as a breakout structure. And look what happens, market after it inverts this fair value gap, this bearish fair value gap continues to move higher. Obviously, same things can happen in a bullish case. We can inverse bullish fair value gaps if we close underneath them, beneath the bullish fair value gap. So let me just try to find an example. Here, perfect example again. So in this case, we have a bullish fair value gap that was caused by a huge displacement because there's a huge buy up, and we have a space created with resting orders that are laying in this gap. First candle, highest point, to the third candle, lowest point, including the wick, of course. We draw in the fair value gap, we see it gets respected a few times, but then, oh my goodness, it gets inversed by this huge sell-off candle, and look what happens after. We continue to move down. So it's very important to understand that fair value gaps can only be inversed if the body of the candle closes, in this case in the bullish fair value gap, beneath the bullish fair value gap, and in bearish fair value gaps above the bearish fair value gaps. If it's only wicking in like this candle, it's a respect of the fair value gap. So we really want to see the candle body closing beneath the fair value gap in this example. So with that being clarified, I think you should understand by now what a bearish and a bullish fair value gap is and how they get inversed. So now let's just talk about what a BPR is. So a balanced price region is basically where we have a bullish and a bearish fair value gap overlapping, creating this balanced price region that the market is preferably trying to revisit. So it acts again as a magnet. And I remember we had this somewhere here. Yeah. Let me just scale into lower time frames. I think we had this happening like on my previous day trade. I want to find this specific example again. yeah, right here. So we can see, this is the 1 minute time frame, by the way. I told you that you can see fair value gaps happening on all time frames, doesn't matter which time frame. So you can see we have here this bearish fair value gap. Additionally, we have this bullish fair value gap. So this price region right here, where these both fair value gaps are overlapping, is creating the balanced price region, which basically means BPR. This balanced price region is a highly probability retesting zone for the markets. Why? Because there's still orders resting here that didn't get triggered in both sides, sell side and buy side liquidity, and market wants to trigger these limit orders, these resting orders, and that's why market is probably going to retest these BPRs. So we also use BPRs as a confirmation confluence for our day trades. In this case, you can see that if we draw this a bit bigger, price eventually came back into this breaker, into this BPR, this balanced price region, and then we continued to move higher. In this case, it didn't work out perfectly because we kind of inversed these things, but what happened after is we continued higher because we just filled in this BPR and then continued higher. So not only can we use this as a confirmation confluence, but we can also use this as a high draw, because we probably know right here at some point, look at this, we have an inverse fair value gap up here too of this bullish fair value gap. And knowing that we have a BPR resting here, maybe place a short trade, I don't know, but you know that this acts as a magnet, and market at one point in time wants to revisit these areas. All right, so we covered already bearish and bullish fair value gaps. We covered already what a BPR is, a balanced price region, and additionally we also covered inverse fair value gaps, and the meaning behind it, and why they are very important for us, and why we basically use them in almost every single trade. So how do we use these building blocks now? It's pretty simple. I want to make it short. It's of course not the only building block that we need in order to place a trade. As I said, it's a confirmation confluence. So we additionally have more confluences to our fair value gaps, to our inverse fair value gaps, to our BPRs. But almost always when we find an entry, we have fair value gaps, BPRs, or inverse fair value gaps playing a huge role into our entries. So I hope you guys now have a brief overview what fair value gaps actually are, what they mean, and how we use them in a day-to-day basis. Yeah, you probably already know from previous videos that in the end we will show you an example of how we use all these building blocks together, but it's just a puzzle piece that is not only being used alone, but with other confirmation confluences creates a nice picture to help us to find our entries. So with that being said, I hope you guys enjoyed this fair value gap tutorial, and see you in the next video. Peace out.